Hey everyone, in this video I've got one ridiculously cheap stock that's down 97.4% off the high that I think investors can buy hand over fist. So in this video I'm going to highlight what this stock is, the reasons why the stock is down so much, and why I see value in this opportunity. So let's jump in, let's see what the stock is and the reasons why I like this stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the stock that I'm talking about here is Peloton. Peloton is down 97.4% off its high, and I've recommended this stock before and it hasn't turned around yet. I've been recommending this stock for a few months now and it seems to be moving lower. The company recently reported earnings that disappointed investors and sent the stock price even lower. However, I still see this as an opportunity. Let me explain why. So if you look at Peloton's most recent earnings for the quarter that ended December 31st, they lost a lot of money on the bottom line. However, let's look at the business and let's break it down. Peloton's business has two segments. Number one, the hardware, the bikes, the treadmills that they sell. Number two, the subscription that comes with the bike and the treadmill for live and recorded classes. The hardware segment, the hardware business is losing money. It's not a good business. The subscription business is an excellent, lucrative, very profitable business. That's the side of the business that I value. The hardware business is just the entry price to get into the subscription business. Let's take a closer look. So for the 3 months that ended December 1st, the connected fitness products, right, the physical hardware, revenue fell to 319 million, down from 381 million. Subscription business, meanwhile, increased to 424 million, up from 411 million. But here's the more important part. Look at the connected fitness products business with 305 million in cost of revenue on sales of 319 million. Barely any profit there, right? Barely any gross margin. But look at the subscription business, 139 million in cost of revenue on 424 million revenue. That's a near 70% gross profit margin. That's a lucrative business. That's the part of the business that I want to invest in. That being said, the connected fitness products business, the reason why it's in such bad shape is because of the commitments the previous management team made during the pandemic. That's why the stock is down so much. During the earlier stages of the pandemic, Peloton's business was absolutely booming. People were waiting 10, 12 weeks to get their Peloton products. There was a backlog of orders. Business was so strong that the management team invested in expansion, a massive investment in expansion. They acquired a manufacturing company. They expanded geographically. They expanded the logistics network. They spent very, very great deals of money, too much in my opinion, and they overextended themselves during that time. Management miscalculated, thinking that this growth would continue beyond the pandemic when gyms reopened. Of course, we all know what happened. Gyms reopened, Peloton's product sales crashed, demand crashed, and the business was in a difficult situation. They were a few quarters ago, they were at risk of going insolvent. They were at risk of going bankrupt. Thankfully, they're not in that position anymore. They're not that much at risk of that anymore. The new CEO that's come in has done a good job so far in correcting from those previous overinvestments. That is not an easy thing to do. That takes time because of the magnitude of the commitments that the previous management team made. It takes time to get out of those commitments. It takes money to get out of those commitments. I think this current management team has done a prudent job in correcting the ship. When they first came on, they mentioned that it takes longer to turn a ship around the bigger the ship, and Peloton is a big ship. So it takes time to turn this thing around. So far, they've done a good job. They've done a good job. It's going to take a little bit more time. So this subscription business is what I want Peloton to focus on. Thankfully, though, now the gross margin of the connected fitness product is positive. However, I don't really see it that way because look at this spending here, sales and marketing, 230 million in the most recent quarter. In my opinion, if they don't spend this much money on sales and marketing, they don't sell connected fitness products. So to me, this I would bring in, if I'm adjusting these statements, I would bring in 150 million of this sales and marketing into connected fitness cost of revenue, and thereby making it still a negative gross margin business. Because without this sales and marketing, they won't sell these units. And so on its own, standalone unit economics is still negative for the connected fitness product segment. I suspect this will continue to be the case. So what management has been doing, thankfully, and I like that they've been doing this, is shrinking this business. 381 million in revenue down to 319 million. They still have a lot of inventory left over that they're working through. They've lowered their inventory commitments, but they still had commitment arrangements from the previous management team. They've made promises to suppliers that have said, we agree to buy a certain amount of inventory from you. Otherwise, if we don't, we have to pay you this sum of millions of dollars. So that's why it takes time to get out of those. You either have to pay that supplier to get out of that arrangement, or you have to actually order that inventory. So as time goes on and Peloton serves those agreements and gets out of those agreements and downsizes, right, which is what this new management team has been doing, more of its business can come from the subscription side, right? And it can shrink this connected fitness product segment and focus it just on organic sales so that they're not spending so much on sales and marketing to generate sales of these connected fitness products. They can focus more on organic sales, more profitable sales, and incrementally add and make sure they're serving these subscription customers really well, because that's the really lucrative side of the business, right? 424 million in revenue on 139 million in costs. So if they completely eliminated this connected fitness product segment, which I don't think they will, because their business is based on these expenses as well, they can't really get out of that business, at least not for a long time. But if they shrink and they become more nimble and focus more on the subscription side of the business, I think profit margins will expand. And they're already improving. Loss from operations down to 187 million in the most recent quarter, down from 331 million in the same quarter the prior year. So already making progress there. Of course, whenever I'm dealing with a company like Peloton that's in a turnaround situation, I need to look at the balance sheet because I need to know how much time they have to turn things around. Do they need to turn things around in the next 3 months, or they're going to run out of money? If so, I don't want to be involved in that situation. But Peloton does have time on its side here. They have 737 million in cash and 427 million in inventory that they're turning into cash. Inventory is decreasing, right? Instead of spending so much money on inventory, just working down the existing inventory balance that the previous management overinvested in. And then the long-term debt, they have 0% convertible senior notes. Doesn't look like these are going to convert because the conversion price for the stock needs to be much higher. I don't see the stock price moving that much higher. And then they have the term loan of 691 million. Thankfully, these debt, the one that's coming due is February of 2026. So they have a year and a half before they have to make the principal payment on that debt. And if you look at the cash flow from operations, which I'll show you here, net cash from operating activities, they lost 110 million in the 6 months that ended December 31st. 110 million in 6 months. That's less than 20 million per month. And they brought that down by nearly 2/3 from 291 million in the same time the prior year. So they're making improvements. They're reducing that cash burn and giving themselves time to become cash flow from operations positive, which if they continue on this trend, I wouldn't be surprised if in the second half of calendar year 2024, if they start to generate positive cash flow from operations on a quarterly basis, okay? So yes, the company's in a tough situation. Previous management overinvested and miscalculated, thinking demand is going to be super high even when gyms reopen. That was wrong. new management, fixing things, moving in the right direction, making prudent decisions, and you've got that lucrative subscription business embedded in an otherwise unprofitable negative business. If it can slowly get out of those hardware sales, slowly get out of those commitments, focus more on its subscription business and make organic sales of the hardware that then lead into subscriptions, I think this business can do really well. Now, you're also getting the stock after the big stock price decrease at a forward price to sales of 0.571. Very cheap price for this business, and understandably so. It's a turnaround play. It's lost a lot of money. There's still a lot of time to go before they can turn it around and make it cash flow positive, operating income positive, and return to revenue growth. Although I think the risk versus reward is attractive here for long-term investors looking for a cheap stock that could provide a multiple X return. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.